All right, let's get right into it. Today, we're cracking open the hood on one of the most talked about dividend ETFs out there, SCHD. We're going to figure out what makes this thing tick and deconstruct the secret algorithm that powers this absolute cash flow machine.
You know, if you spend any time at all on financial social media or in forums, you've seen this exact phrase. I mean, SCHD has this incredibly passionate, almost cult-like following. It's always held up as the benchmark, the one everyone else is trying to beat.
But why? Seriously, what is it that makes this fund so special? Out of the thousands of funds available, what's the secret sauce here? Well, the answer is probably not what you're thinking.
See, the secret isn't some superstar manager making brilliant calls based on a gut feeling. Nope, it's an algorithm. A cold, calculated, and totally ruthless machine that's been programmed to systematically hunt for quality and just get rid of everything else. And today, we're going to take a peek at its source code. This whole machine runs on a super strict, four-step blueprint. First, it defines its universe of stocks. Second, it scores them. Third, it picks the best ones. And fourth, it weighs them to manage risk. So let's walk through exactly how it does that. So let's start with step 1, the quality gatekeeper. Think of this as the bouncer at the front door. Before any of the fancy analysis happens, the machine has to take the entire U.S. stock market and filter it way, way down to just a small pool of really durable, high-quality businesses.
And the first filter is a brutal one. It's a test of endurance. A company must have paid a dividend for at least 10 years in a row. Now think about what this does. It instantly kicks out all the speculative tech companies, the cyclical businesses that slash their payouts when things get tough, and any of those flash-in-the-pan companies that haven't even been around long enough to see a full economic cycle.
Next up, the machine demands size and liquidity. We're talking a market cap of at least $500 million and a high trading volume every single day. And why? Well, it's pretty simple. This makes sure every single company in the fund is a legitimate, institutional-grade company, not some tiny, illiquid stock that you can't even trade easily.
All right, so the machine has filtered out all the riffraff. Now we get to the really juicy part. Step 2, the Core 4 engine. This is the absolute heart of the operation. It's where the real brains are.
The algorithm uses 4, and only 4, ruthless ratios to score every single company that made it past the gatekeeper. It checks their solvency, their efficiency, their income, and their ability to compound. Let's break each one down.
First up is free cash flow to total debt. Think of this as the ultimate lie detector test. You know, earnings can be fudged with accounting tricks, but cash, cold, hard cash, is a lot harder to fake. This ratio makes sure the machine only picks companies that are basically swimming in cash, not drowning in debt. Second is return on equity, or ROE. This is the efficiency test. It's asking a really simple question: how good is this company at turning $1 of our money into more dollars? A high ROE is a classic signal of a fantastic business, one with a real competitive advantage.
Third, we've got the dividend yield, the income test. But what's really smart here is how the machine uses it. See, yield is only one of the 4 factors. This is a critical safety feature. It stops the algorithm from falling into a yield trap, chasing those stocks with a crazy high yield only because the stock price is totally collapsing. And finally, the 4th ratio, the 5-year dividend growth rate. This, my friends, is the engine of compounding. The machine isn't just looking for a decent yield today. It's looking for companies that are cranking that payout up year after year. And that is one of the biggest votes of confidence that management can give about the future.
Okay, so the machine has its pool of quality stocks, and it's scored every single one. Let's move to the final steps, where we see how it actually builds the portfolio and puts some guardrails in place.
The process from here is dead simple and completely systematic. Every stock gets a final composite score based on those 4 ratios. And then the algorithm just picks the top 100 highest-ranking stocks. Period. It even has this little volatility buffer built in, so it doesn't just dump a great company because of one slightly off quarter.
But just picking the stocks isn't the end of it. The machine then installs some really important safety valves. First, no single stock can ever be more than 4% of the entire fund. This is just basic risk management. It prevents one company from having a disaster of a year and sinking the whole portfolio with it.
The second safety valve is a sector cap. This is all about diversification.
No single slice of the economy, not tech, not financials, not healthcare, nothing, can ever be more than 25% of the index. This keeps you invested across the whole economy, not just one hot sector.
And here comes the ruthless part. This whole four-step process, it gets repeated from scratch every single year in March. And if a company's numbers have slipped, if its debt has gone up, or its ROE has dropped, it gets dumped from the index. No questions asked. The algorithm has zero loyalty. It only, and I mean only, follows the rules.
So, why does this all work so well? I mean, why has this cold, emotionless, mechanical process been so darn successful? The answer is all about what it manages to capture along the way.
And here is the truly brilliant result of that whole process. Whether it was by accident or by genius design, the SCHD algorithm ends up capturing three of the most powerful, historically proven factors in all of investing: value, quality, and growth. It systematically zeroes in on companies that are cheap, high quality, and growing. And that, right there, is the crucial point. The machine's biggest advantage is that it isn't human. It follows rules while we follow hype. It's completely emotionless while we panic sell at the worst possible time. It's systematic and patient while we're off chasing the latest fad. This system is basically designed to protect us from our own worst instincts as investors.
So at the end of the day, you can really think of it like this. When you buy this ETF, you're not just buying a basket of stocks. What you're really doing is hiring a cold-blooded algorithmic auditor, one that works for you 24/7 to make absolutely sure your money is only in companies that are profitable, efficient, and friendly to their shareholders. Which leaves us with a pretty interesting question. Can a machine with no gut feeling keep on beating the humans who have one?